Netflix is going to make a 10-for-1 stock split, and it's at all-time highs. It has grown fast during the last 3 years. Does it mean a buy now? My investment is going to change. Should I put all my money there before it's too late? Wait. Let's hit the brakes and listen to me. I'm going to guide you to make an informed decision without having to read financial reports and statements just like I did. First of all, what is a 10-for-1 stock split? Suppose that you already have one stock of Netflix that you bought for $1,000. What will happen in November 14 is that you'll receive 9 more stocks, leaving you with a total of 10 stocks. Does this mean that they will give you 10 times your investment? No. The reality is other. At the same time, the price of your stocks will be divided by 10. Therefore, the price of 10 stocks will be the same as an old stock price. You can calm down, because stock splits do not inherently change the value of a company. But why Netflix could do such a weird movement? Easy. The stock price will be more accessible for the people to buy them. It is an estimation that the value of each stock will be near $70, more affordable than the actual price. Therefore, is this a sign to buy? As I mentioned before, splits don't change the market cap. It's just a change of numbers, but not about value. But if you're not satisfied with this answer, I'll give you valuable information that can help you decide. Remember, I'm not a financial advisor and you have to make your own investigation. But here are some details that you cannot overlook. First, the net income. It has been increasing in a ridiculous rate over 10 years, with an average of 69% every year. Not bad. Also, there is a factor that I personally use to see what decisions are they making with all that money. The factor is long-term debt. They are dangerous and even worse when bad times for a company comes. As you can see, they are increasing the long-term debt along the way, with a try of reducing it, failing in 2025. Therefore, Netflix is drawing in debt? We have to take a look at this pie to find out. It will show you if they can afford that debt with all the cash they have. As you can see, long-term and short-term debt are bigger than the actual cash and short investments. In numbers, they have around $6 billion of net debt. Everything could be alright if they use the future income to pay this debt. But that's not in Netflix's mind. What are they using most of the money in? Rebuying stocks. There's been a significant amount of cash in repurchasing common stocks. This mostly happens when the company is at low stock price. The company, knowing the great business they have, starts rebuying stocks. But this is not the case. Netflix is at highest prices in 2025. So, what could be happening? This can be a tactic to inflate the price in a legal way. Buying all these stocks will inflate the EPS or earnings per share, which can look more attractive to investors. With the split, they seem cheaper, which can increase the demand. That's how you can inflate the price. And it is why I will personally wait for a crash or a correction to buy Netflix stocks. Remember, this is not a financial advice and you should do your own research. In my case, the stock is expensive and growing at this rhythm won't be forever. They are focusing in buying stocks than having better fundamentals, which I personally don't like. But I could be wrong. Maybe they are really growing as fast as the people are guessing. Netflix has been looking for other ways to get more cash and justify their price. Leave a comment about your thoughts. Have a good day and always keep learning.